Hello, Michael Swanson of WallStreetWindow.com. We're entering a very interesting time in the financial markets, especially for gold, silver, and mining stocks. I'm going to show you the charts in a second on them. But first, you got to understand the fundamental backdrop that's leading us to this moment, and that's the Federal Reserve and Janet Yellen. Now, just 2 weeks ago, Janet Yellen gave congressional testimony. She does this twice a year, and when she did so, she made some bombshell statements. It was in her written statement that she also gave to Congress too. Now, if you can remember, back in December, the Federal Reserve released something called dot plots. It contained their predictions for what they're going to do with interest rates. And it claimed that they would raise rates 4 times in 2017 and then more times in 2018, and rates would just be going up and up and up. And bank stocks, of course, rallied on that news. And those predictions were predicated on the assumption that economic growth would accelerate this year and beyond. Now that really did not happen, even though the stock market went higher. So the Fed raised rates only twice so far, and now they're unlikely to do it this week, unlikely to do it in September, and expectations in the markets are there's about a 40% chance they'll do another one at the end of the year in December. So less rate hikes than were expected, but in Yellen's statement, she basically said that they'd only actually raise rates 1 or 2 more times anyway, to get to what she said would be a neutral monetary policy stance. And then the Fed would pause, probably for a year, maybe 2, and then raise rates up even more once economic growth then began to materialize and accelerate. So these are her new revised predictions. But really it's a hope, and not so much a solid prediction. It's a hope that, okay, we're at near neutral, we're going to have to stop. And the reason why is because while the Fed has raised rates 2 times this year on the short-term end of the yield curve, the long-term 5-year, 10-year, 20-year interest rates on the bonds have actually gone down while the Fed's raised rates. That's because those are influenced by traders in the financial markets, and they've seen that the growth has not materialized, so they force rates down lower. And what happens, though, is if the Fed were to continue to raise rates, they get into a situation where the short-term rates are higher than the long-term rates and create an inverted yield curve. That would be a very negative development. The Fed does not want that to happen, and hence we're now at this moment in time where, as she announced 2 weeks ago, we're now near neutral. And she just can't raise rates but so much, and once she gets to that point, it's all over. And so we're near the end of the Fed rate hiking cycle. Now, another final comment about that speech that's very important is the expectations are in September that the Federal Reserve is going to announce a plan to reduce its balance sheet that's been built up thanks to all these quantitative easing programs. And I actually think this is going to become sort of a distraction talked about in the financial media to make people think that the Fed is actually hawkish, that they're concerned about inflation, and not really pay attention to the fact that we're at the end of the Fed rate hiking cycle. But in her statement that she released to Congress, at the end of it, she basically says this is not going to represent any tightening at all. And in fact, she said that if the economy were to slow down, or even the stock market were to decline to cause that, that the Fed would lower rates again and engage in quantitative easing all over again. Now, this is all very important because monetary policy impacts the currency markets, it impacts the value of the US dollar and gold. A loose Fed policy is bullish for gold, and we're at the end of the cycle, it's bullish for gold. It's as simple as that. So that's a great place now to put money to work if you have not done so already, to diversify, and also simply to make money as things go up. And I believe we're now at a moment on the charts and in the futures market where we basically have the gold bull market fueled up again, and it's just going to take the lighting of a match to make the rocket go up. Let me show you why I'm making that statement like that. This chart you're looking at here is what hedge funds are doing with gold in the futures market. Now, they had the lowest net long position in gold that they've had since January 2016, right before gold took off and the mining stocks more than doubled in the space of 6 months. It was the last big, gigantic rally. I think it's the first rally within a bull market, and typically when you get the first big rally, you then get a pause, a consolidation phase that can last 6 months, 10 months, even 12 months. This one has lasted 12 months. You can see the trend line right here. This is the GDX Gold Stock ETF and what's been going on. A breakout of that, consolidation will launch the next bull market, or the next bull rally, I should say. But it's not only this specific data point with the hedge funds. If you look at the Commitment of Traders report, you also find out that the commercial hedgers and producers who use the futures market to hedge their own positions in production, they now have the smallest net short position that they've had since the first quarter of 2016 too. So they also are positioned for a gold rally. At the same time, the people who tend to be wrong in critical turning points, the small individual trader, the small individual investor in the futures market, they tried to short 5,000 contracts 3 weeks ago. The last time they tried to short a couple thousand contracts was also right before the gold rally of 2016. So it's all positioned in the futures market. Now, the most reliable indicator I know, though, is the GDX divided by GLD ratio. This ratio, when it goes up, it means the mining stocks are outperforming gold. When it goes down, they're underperforming gold. During bear markets and during correction phases, it trends down. When you have a rally that's not simply a rally, but a rally that's gigantic, a rally that's going to lead to new highs and beyond, a big rally, the ratio trends up. As you can see on this chart, it also, like GDX, has been in a downtrend, but it's in a position where it can now break out any moment. All it would take is one day in which GDX, or the mining stock complex, is up 2, 3, 4, 5%. One big up day will trigger a breakout. That's where we are. It could happen tomorrow, it could happen next week, it could happen next month. I have no way to predict that, but it's not important to predict it. What's important is not to know the exact moment something's going to happen, but to understand these trends, understand how to use these charts, understand what's lining up, and get positioned ahead of the curve. That's what I've done. That's what I advocate people do. And if you feel uncertain, you just watch this setup, and you'll see it. You'll know when the rally starts, if the GDX divided by GLD ratio breaks out, that it's real and not just a bounce, because we have seen a couple of bounces this year that faded out. But this ratio breaks out, it's going to be a big one. And I want you to make sure you've got your eyes on this and you're ready to act if you're considering it. Because I think this is going to be the best way now to make money between now and the end of the year. I know the stock market's gone up a lot. I know stocks like Facebook have gone up a lot. Stocks like Nvidia have gone up a lot. Bitcoin has gone up a lot. But I think gold right now is positioned at the similar moment as it was in the first quarter of 2016, right before the last gigantic rally. And for gold stocks, it was massive. And this is where we are. This is going to be an interesting week to see what the Fed does and to see what gold now does on a daily basis, because at any moment it can all begin. And what you should do, if you are coming to this YouTube channel for the very first time, subscribe to it, and then you'll get my next video and get on my free email list for my action updates I send, just depending on what's going on in the markets, at least once a week, but sometimes more than that. And I'll be talking with you later.